Right, welcome back. Still with me via Zoom, our Grant Nader from Benguela Global Fund Managers and Ricus from PSG Hole in One Ruimsig. What's behind Alex Forbes' strong run, and will it continue? I actually took a look at it today and it is up about 5%. Pretty significant moves there, Grant.
So I think the viewer is talking about the longer term. Alex Forbes has the last, I'd say, 2 years. They've had a bit of a shake-up internally, operationally. They've been executing well, and for a long time, this company had a great brand, but a very poor operational delivery. I think they've turned that around. They have a much clearer strategy and are executing well. The numbers are starting to improve, sequentially for a long time now. So I think that's behind this re-rating. Having said that, it's run hard. It's now trading 17 times earnings. I'd be careful at these levels of paying for it, but I think it is a good business. It's a good business model. They've got strong franchise value, and they've got a decent leadership in place. So I quite like the business. I'm not sure I'd pay for it here, but I'd keep it on my radar.
Okay, interesting. On Grant's radar, but maybe not too sure about entering at this point. Ricus, your take on that rally? And if it is set to continue.
Yeah, following on from what Grant said, I just had a quick look at it, at the price move versus its sort of major competitors over here, whether it be 91, ourselves, PSG. And certainly over the past 3 or 4 months, it's underperformed. So the price has run harder and it's taking a bit of a breather. Longer term, over a year and a half, it's basically done what that sector has done, asset management. Asset managers hasn't outperformed or underperformed except for maybe versus 91. But the growth story going forward, also as Grant said, where they're basically reinventing themselves, quite interesting and certainly something I'm keeping in the back of my mind.
All right. Well, there's a very interesting question here on futures. The viewer says, I have performed well since starting my US portfolio, averaging a compound annual growth rate of 23% for the last 4 years. This being said, I'm looking at taking on a bit more risk using futures. I'm currently looking at a position in PepsiCo with a stop loss at $110 and take profit of $200. I'll roll over the futures if need be. I'd just like to hear the panel's thoughts about this potential trade. Grant?
Yeah, so look, I think I'd like to know more. You know that old saying, don't confuse bull market with genius. The US market has done more than 20% in the last 2 years in each of those years. So just bear that in mind. Your futures you're generally taking risk on like 10 to 1 leverage. So for every R1 you put at risk, you've got 10 Rand exposure, and that money can disappear quite quickly. So I would say it's for sophisticated investors. Just do your homework.
Yeah.
Be very clear about the risk you can and want to take on. And I would start slowly. And just be careful and manage that exposure. It's great if you are sophisticated and you have strong technical knowledge. Go for it, by all means. But I wouldn't suggest you swing your whole portfolio into futures, because you can gear up your exposure massively, which works well in your favor, but it works equally but poorly when things go against you. So perhaps just find a balance there.
Okay.
So I like futures, but you need to just know what you're doing, know what you're in for.
Well, lucky for me, I'm talking to sophisticated investors with a strong technical knowledge. Your insights, Ricus?
Yeah, I'm not sure what the PepsiCo share price is doing at the moment, but it would be considered fairly defensive, I would imagine. And we were talking at the start of the program about the US economy slowing. So it's volatility-wise, it's not as volatile as, for example, Nvidia, where if you would take a futures position in, for example, Nvidia, you'll have to be very, very, very careful as to your exposure to that volatility.
Yeah.
To that volatility. So leading on from what Grant says, you've got to be sophisticated. But yeah, if you want to try it out and you've got your stop losses in place and you're prepared to take a loss when you when things don't go according to plan, then starting off in the less volatile side of the market is probably not a bad idea.
Yeah, all right. Well, as we're talking about NVIDIA, I'm actually interested in what you've taken out from the US tech earnings. We've had 4 of the Magnificent 7 companies reporting. Of course, we know the pressure that those stocks have undergone in the last few months. Grant, your takeouts.
I think the numbers have been very good, and we must remember that US tech is not a good. It's not on the tariffs. So, Google doesn't import anything. Microsoft doesn't import anything. So they're selling a service and it's software driven. So the numbers are solid. I don't think they are immune from sentiment fallout around, people turning their back on US companies, looking for alternatives. So it's not that they're bulletproof, but at this stage, they haven't been in the face of the tariff war, and then so they're lucky from that point of view. The other thing I take out is the increasing spend on infrastructure, data center rollout tells you that from their point of view, the AI trade is very much alive and well. They're not only continue to invest, they're investing more than what was expected. I mean, Google alone upped their forecast by another 10 to 15 billion. Facebook, Meta did the same. So that trade is alive and well, which also talks to Nvidia and some of the other semiconductors as well. And I think I think it was a good number. The advertising continues to be strong. That could be vulnerable. So there's been a bit of a bifurcation between retail focus, like Amazon piece, in terms of how those shares have done, and Apple, who are vulnerable to China because they sell, I think 20% of their revenue comes out of China. Those that are immune and isolated have actually done well and continue to do well. And I think any pullback there is a real opportunity for investors.
Okay, finding opportunity. Ricus, how much appetite do you have for those tech stocks after these results? But also maybe outlooks that maybe are not as solid as the current results. I mean, as much as they're not good, but Grant talks about the impact of sentiment and I guess just broader economic growth.
Yeah, look, they've pulled back quite considerably over the past, since the 2nd of April, where we're sitting at historic PEs before the announcements that were on the face of it quite favourable. But as Grant said, and if you take a look at the 5 that's reported, Google was like, meh, okay. Microsoft did very well, as did Meta, and the people who actually sell things, Amazon and Apple, not so well. So you can see how tariffs has had an effect on, the iPhones and whatever Amazon imports from China.
Yeah.
So I would certainly probably not concentrate on the latter 2. But on the first 3, service-wise, as long as we don't get a lot of tariff blowback from countries outside the US on that service component of their sales, all look decent. One thing that I won't say concern, but what I'm wondering about is, taking a look at something like Meta, the amount of capital spend that they are doing and the amount that they are depreciating per year on that capital spend. That gap is increasing quite at a considerable rate.
Yeah.
And as we all know, at some stage you're going to take a look at earnings and you're going to measure it against what capital you've employed and how that is going to impact, just the the dollar amount that you're getting for the amount of capital that you spend, if you are trying to just keep your earnings steady by not depreciating as much as you want to. That to me is a bit of a flag. So I want to really see how that's going forward. But yeah, let's face it, the industry might be under pressure, but it's still the best companies in the US, I would imagine. So sentiment might affect them negatively, and certainly if we see a sentiment-driven price decline in prices of those stocks, they would be very, very attractive. At the moment, I'm a bit ambiguous because not sure, again, going back to the start of the program, what's going to happen not only with fundamental data coming out of the US, but also investor sentiment based on that data.
All right. Well, we're not just looking at what you gents are buying. There's a question here. What are the analysts lightening up on or offloading? Just looking at the market, Grant, would you be looking at offloading some of your exposure to maybe some sectors, some stocks, some geographies?
And it's a tough one because in many ways the ship has sailed to some extent. If you're selling after the 20% pullback, you're often selling at the wrong time. So one needs to be careful. And if you're waiting for certainty to buy, well, by that stage the shares have already, of priced it in long ago. So you've got to just pick your line in the sand and find the stuff you really want to own with a longer term view for the buy side. For the sell side, I think the consumer discretionary is probably where the most risk is, because even if they resolve things with China, how do things unfold in the economy? You can undo some things, you can't undo others. So it doesn't turn off and on like a light switch. That consumer impact may still feed through the economy, but then the Fed may come in and cut rates. So you've got a lot of moving parts. There might be tariff agreements with China. I'm reluctant to do too much. We have reduced somewhat our consumer discretionary stuff, like Apple, because there seems to be more obvious risk there. Retail materials like commodities, you have to be careful. A slowing global economy will slow down and will impact commodity prices. And so the miners, I think, are a little bit at risk there. Perhaps gold has run a bit far. That might pull back a little bit if there's some resolution or improvement in the outlook around trade. So there's not a lot of areas where I think you need to be urgent and sell now, because I think a lot of that ship has sailed. But think about those as vulnerable areas.
All right. Ricus, where would you be looking at, limiting your exposure at this point?
Well, let's start off with the question that you asked and where people have moved their money to. If you just take a look, first of all, price. The US market since the start of the year is underperforming its major counterparts. So that tells you the start of the story. People moving out of US stocks and just broadening their geographic spread, and that's also underpinned if you focus away from price and just take a look at where the money has been flowing to. And there you can see a decline in US investment as well. In fact, if you take a look at something like the dollar index, which is a measure of, let's say the dollar's price, it tracks almost perfectly if you track it against the Nasdaq. People have been selling out of highly overvalued US tech shares and moving it more defensively, either geographically or into sectors which are more defensive, whether it be something like utilities or retail. And that ties in with what I've been doing, lighting up on, as Grant said, your cyclical consumer type of stock and taking a little bit of refuge into either cash or the utilities retail property side of things.
All right. Well, gents, let us get to what you're buying. Your stock picks for today, Grant. What are you hanging your hat on?
On this note, I'm buying Meta. They reported yesterday. It's still an incredible business. They've got 3.4 billion daily active users. I mean, America is only 360 million people, so they are global, a truly global business. Ad revenue growing, impressions growing, price of ads growing, and they're still growing operating margins as well as they're spending on their capex. It's just an incredibly powerful franchise. There is some regulatory risk about Instagram and WhatsApp maybe being broken up. I think in the US that kind of thing is difficult to predict. So taking that out of it, at 22 times earnings, this quality business, do I want to own it 5-10 years from now? Will I look back and say, I'm glad I owned that? And, I think it's a yes, and I think it's a great business. So yeah, that's my pick, is Meta.
Okay. Ricus, where are you finding opportunity today?
Yeah, sort of staying in the tech side of things, but locally Altron, which are due to report their earnings a little bit later this month. They've already had a trading update and expecting EPS increase of, I think, about 40%, which is great, except that they've also warned that their second quarter wasn't all that great. So I would tend to wait and see what the price done or what the price is doing around the earnings release. But I think just taking a look forward, sitting on a forward price earnings of probably about 11 or 12 or something like that. And they've got earnings growth of 14, 15% going forward, which I think is quite maintainable. So it's exposed to the right kind of sector because they do provide things like cloud services and helping companies through that. Obviously, Netstar is the other side of the business, which I think, although competitive, is should be doing okay. So with that kind of earnings growth rate, the refocus that the company has done over the past number of years, it's a far better run company. I think on that kind of valuation, they're probably too cheap, and they've had a nice pullback, and I can see them quickly or possibly retesting its high of a few months ago, which would give you about a 17-15% appreciation in price plus about a 3% dividend yield again. If you can do 18% in a volatile market such as this for the next year, I don't think you're on a bad wicket.
Well, thank you so much for your time and for your analysis today, gents. Really appreciate it. That's, my guest, Grant Nader from Benguela Global Fund Managers and Ricus from PSG Hole-in-One Ruimsig. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep sending your questions. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.